Well, I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market started out this holiday shortened week looking really ugly, as by the second hour on Monday, the S&P 500 was down 90 points, and that was what was the worst 3 days for the stock market since May. Investors were panicking as a multitude of news items came out that was really negatively affecting an already weak stock market. And tech stocks, energy, solar, they led on the downside. Oil was down $3. So it was a really horrible looking market on Monday. Omicron surging throughout the world brought a shutdown or lockdown in the Netherlands and many restrictions here in the U.S., cancellations of many events. The BBB, Biden's signature program, looks dead, though he denies that. So the monetary stimulus, at the same time that fiscal stimulus was changing, all seemed like it was gone. Goldman, in response to that, cut the U.S. growth rate in response, and China, facing a real estate collapse based on their tightening and all of the defaults that are coming in those real estate companies, well, they tried to calm things down and cut rates, but they have got huge issues over there. And the major central banks very much seeming like they're out of step with each other. So all of that really had the market looking bad on Monday. But of course, this is a period of favorable seasonality, and we saw Tuesday and Wednesday bargain hunting coming in and continuing now through Thursday. And we had big market rebounds in the reopening stocks, travel, cruise, all of those moving up pretty sharply. Tesla, a big rebound on Wednesday, it was up 6%. Musk said that he had sold enough. And he did say that he had sold now $15 billion worth of Tesla stock. He didn't really say he was done. He just said that he had sold enough. And that stock rallied, actually. It made a low of 886 and then rallied 14% off of that low. Apple, well, that rose, but that had a real rough time. Citigroup raised its target in there and maintained it as a buy. The stock had moved down from 182 to 167 in just 5 days, 15-point loss. That's a lot. Our work shows Apple going back down to about 165 or lower by March. And Tesla, which now has had this big rebound over 1,000, we have a target in late February of about 875, as we believe that the market will face a weak period pretty soon. I've got more to say about that. Here on Thursday, short day on the holiday. Traditionally, it's an up day, as is next week. Consumer spending came out. It was the best upward pace in 39 years, and so the market like that got to question whether it's good or bad. It is food for inflation and food for interest rates going up, and the bond market didn't exactly like that news, with the 30-year bonds falling about a point today on Thursday. So the stock market is coming into a period of high risk based on our work. The S&P 500, as we've said, may inch out a new high, but the whole list is really much worse. Our big picture analysis we did, which is essentially our year-end look at the stock market. If you're not a member, you really should become a level 2, 3, or 4 member to be able to watch that. And we talk in there that there is a market trough, a low due or big selling due into the February-March period. So we see sometime just after the beginning of the year, the market entering into a very risky period. This has been our analysis all along, feeling like the high would be made early in the first quarter and then the market would run into trouble. But in that video, we describe several periods of potential risk in 2022. So the short term, actually, for the next 2 weeks, though the market is getting pushed up here based on seasonality, we think there is risk again that we'll see selling return to the market as we saw in the previous couple of weeks. And I'll show you that at the end of the show, how that lines up. Now, I'm going to ask you, a lot of people watch this part of the show and then scroll forward. I'm going to ask you, please don't scroll forward now. I have something new to show you. A new scanner here at askSlim that is going to really be fantastic for traders. So I want you to stick around. I'm going to show you that in a couple minutes. For the stock market for the week, it's up, depending on the index you're looking at, close to 2% or maybe as high as 3% on a big rebound in the Russell. But the NASDAQ and the Russell did have breakdowns this week that spell trouble. Bond market, 30-year down about 1 3/4 points for the week. The 10-year yield's up 8 basis points and is stuck really in a range, now trading at about 1.49%. We see a range in here for the next few weeks of about 1.34 to about 1.55, but then trouble for the bond market where we think a spike is coming. And I have a segment to show you about that in just a couple of minutes. The gold market up $3 on the week, silver up 34 cents, and we tell you we believe it is going nowhere for months. The dollar fell about 0.5%. We looked for a double top around 97. That looks like it came, and now we have a short-term target of about 95.50 in the dollar. That actually should be a little bit of a window for a favorable period for a rise in the metals. So we think that there's a short-term period on here we could get a lift. We might see gold 1820 to 1840, but we don't really think it's going anywhere after that. The oil market, unchanged on the week. It's in some resistance, as is gasoline and heating oil, and we do expect that they're going to reject these levels here and then begin to move to the downside again. That's for the energy market. Coming up, we're going to announce this askSlim Market Monitor. This is a scanner that is just fantastic. So I want to show you that, and Arvi's going to present that to you. And also we're going to do a little segment in here where I'm going to look at the coming interest rate spike. And that's, I think, very interesting. You're going to learn about some cycle analysis in there. And then I'm going to do a stock market review looking at the weekly and daily of the SPY, the spiders. And I think this is some great stuff that is coming up in this video. I want you to go to askSlim.com and take a look over there. You can become a free member, if nothing else. We have tons of specials I'll show you. If you're on YouTube, please do subscribe to this channel. Click that notification bell and give us a thumbs up. On Twitter, follow at askSlim. And if you have questions about what we're presenting here, the analysis, our specials, please write to Matt at askSlim.com. All right, our holiday special, and don't go away because there is something new on here that's fantastic. Our great holiday gift for traders and investors, so you give the gift of askSlim. We have special rates, 3-month membership, non-recurring. You won't be billed again. The person you give it to won't be billed again. Give that gift to someone you know who loves trading or investing, or give it to yourself. Great for first-time members. Or use this special membership to try one of our higher levels. And as a bonus, we're going to send you back an Amazon card to help you give gifts to somebody else, pay for some of signing up for askSlim. And now this amazing added bonus, the askSlim Market Monitor. I want you to watch this because this is just absolutely great and crazy. Arvi's going to show it to you right now.
Hello, this is Arvi Ramachandran. In this video, I wanted to take a couple of minutes to introduce our new askSlim Market Monitor to our members. The askSlim Market Monitor uses our proprietary studies, which include the Reversal Scout, Slim Ribbon, MCI, and OBI, to provide an at-a-glance view of the condition of the symbols in your watch list. This is a fully customizable solution, and the Market Monitor really allows you to scan and sort your watch list based on any of these indicators, and that's why we think it's really super valuable. As part of our holiday special, in addition to the Amazon gift cards, we are also going to include the Market Monitor for the first 50 people who sign up for either a level 4 or 4 plus membership. And as always, our existing level 4 and 4 plus members will also get access to this great tool. So with that, let's go ahead and take a brief look at the monitor itself. So this is the askSlim Market Monitor, and currently we have this set to the askSlim focus list, as you can see right there, which is the set of stocks that we follow very closely and update 2 to 3 times a week for our askSlim level 3 and 4 members. What I want you to first focus on are these 4 columns to the right here. On the left, we have the askSlim Versal Scout right here, which is the most sensitive indicator, and then we have the Slim Ribbon. After that, we have the MCI, and then we have the least sensitive indicator of all of our indicators, which is the OBI. And what we'll do is really go from left to right here. So what I first want to highlight is, just from a visual point of view, just the greens and reds that you see in these first 2 columns. It'll give you a good sense for what is the underlying state of the market right now based on some of these top traders. And what you'll see if we just scroll down here is really a mix of green and red. So clearly a very mixed picture there in terms of that daily momentum in the both Versal Scout as well as the Slim Ribbon. Next, I want to shift to the MCI. The MCI uses multiple time frames to really come up with a sum of the evidence condition on an underlying stock. When it's plus 25 or higher, that's a bullish condition. When it's minus 25 and lower, that's a bearish condition. And when it's in that range of plus or minus 25, that's really more neutral. And what you can do here is you can sort by MCI, which is really cool. So you can see these are the most bearish stocks based on the MCI. We see FSLR, CRM, SQ, XRT, EEM, GS, JP Morgan. If we now sort by the most bullish names, you can see that we have AVGO, Amgen, MCD, NEM, FedEx, Costco, and Micron. Now let's go ahead and shift over one more column to the right and look at the OBI. The OBI was really built with option traders in mind. It gives you a sense of bias for those traders with a 30 to 45 day time horizon, which is really a lot of swing traders. And when it's either +2 or +3, that tells you that you have a bullish bias. If it gives you a +1 reading, that says that the overall bias is positive, but on the very short term, it's a little bit overbought and the odds would favor a pullback. And conversely, on the downside, if it's -2 or -3, that's a bearish reading. If it reads -1, that says that the overall reading is bearish, but it's a little bit oversold in the short term, and you'd be watching for a bounce. So let's just look at MU here. So for MU, you can see on the Reversal Scout, it's +1. On the Slim Ribbon, it's also +1. So that tells us we have really bullish daily momentum right here. We also have a very positive reading on the MCI at +78. So that says that we have a very bullish underlying condition here. Now note what the OBI says. It says +1. So that says that the overall trends are positive, but it is very overbought here in the short term, and the odds would favor a little bit of a pullback. So what do we do with this sum of the evidence here? It says watch for a little bit of a dip and then look for higher highs after that. And we can tell all of that just from these 4 indicators, and I didn't even have to open up a chart. And that's why this is really so valuable, and why we think our members are going to really love this. So I hope it was helpful to walk through this use case here in Micron, and you can really do this for any of the symbols here. You can look at any of these symbols and get that at-a-glance view of that underlying condition. I also wanted to briefly touch on an enhancement that we have made to both the Reversal Scout as well as the Slim Ribbon PO. We have added in new code that now allows you to get alerts sent directly to your thinkorswim desktop application. This is something that our members have really been asking for a while, so we are really happy to bring this to you as well. Keep an eye out for an email from us with both the Market Monitor as well as the updated Reversal Scout and Slim Ribbon PO Think scripts. Lastly, I do want to note that we will have a webinar in mid-January for our askSlim Level 4 and 4 Plus members to answer any questions that you may have on how to best use our tools. That's all I have for now. Thanks very much for listening.
All right, that was fantastic. Arvi presented that beautifully. This is a great tool, our new market monitor. I want to invite you to go over to the askSlim website. And this, of course, is for level 4 and level 4 plus members. Here's the website. You can just click on this top, save 30% or more, and that takes you to our special page where you can see all of the information in all 4 of our gift memberships, and you can see that we're going to send you back these Amazon gift cards right in here. For level 4, we'll send you back a $100 gift card, level 4 plus a $150 gift card, and you'll be able to get that great information that we offer you in all of these memberships. I want to also show you that if you're going to be a level 4 member, you need to have a TD Ameritrade Thinkorswim account, and I'm just going over and scrolling over on our front page there, and this is where you go, click on that. We will get credit if you open this TD Ameritrade account, so I want to encourage you to do that. Become an account holder at TD Ameritrade Thinkorswim. That's our preferred broker. We run all of our charts on there, or most of them at least right now. So please do open up an account and become a level 4 member. This great opportunity. Only 50 packages available in this new scanner that is going to be immensely helpful to you in your trading. So thank you for watching that. I think it is fantastic. All right, this is a special big picture review of 10-year yields, the coming interest rate spike. So I tend to do big picture analysis for our members. I've recently put some of these in the Market Week show for everybody to see. And I wanted you to see this one. I think it's important because I do believe that the stock market is coming to a period in the beginning of the year that it's going to struggle. And the fact is that the alignments for our analysis shows interest rates moving up and in a big way. That is likely going to bother the stock market and bother investors. So I wanted you to have a picture of that right now so you could get a sense for the conditions of interest rates. The first thing we're going to go to is a monthly chart. This is the monthly chart of the 10-year yields. And what we're looking at here, after a nearly 40-year bear market, are these declining yields. Now, if you're new and you aren't familiar with this type of analysis, this is cycle analysis. And what we look at is the heartbeat of the market, essentially, the rhythms that you see right in here. There are 3 cycle rhythms in these harmonics. 22, 44, and 66 months is what we're looking at. The 66-month cycle shows the dominant lows right in here where they come in, and one of those came in right over here. These green areas that you're looking at are the rising phases. They tend to last 6 to 28 months, and they move up at least 50% on the upside as a retracement from the last low. That takes you all the way back here to 1998 and all the way up here to where present time coming into 2022. So about 23 years we're looking at this. The key thing that I want you to note in here is that there's a minor cycle, an intermediate, and a dominant right there that bottomed here. Now what has happened is that minor cycle is coming to its corrective trough right there. The last time that we saw this type of a setup was way back over here, where the first minor cycle set up in a bullish way, where the peak, where the trough was above the previous trough. That set up the next big upward move right over there, which essentially sent yields from a level of about 3.8 all the way up here to about 5.3%. So that was back in 05, 06 that occurred. So we have the same thing right in here in January of 22, where all phases, all 3 of them, are going to be rising at the same time. That is very likely to bring similar action to this, and you can see our projections. I'm going to bring this in a little bit tighter for you to see, and what this points to right in here is that this corrective period is about to end, and we're about to get into this next rising phase right here. Because this is so far off the previous low, it says that This rising phase is continuing on the intermediate cycle. It's continuing on the longer term dominant cycle, and the minor one, which has been correcting and it hardly can come down, is about to turn up again. When you get into that type of a setup, you get an upward spike in yields. And that is at worst case going to take you up to about 1.8%. This is probably a better target up here, closer to 2.2%, with a potential up here at about 2.6% sometime, or this would be sometime around mid-year. The peak, the shorter the rally, the earlier the peak generally, and you can see that's how we have each of these peaks later in time. So there's a period right in here that is very probably going to bring a big upward move in yields, a spike, and that would be coinciding with a big downside move in the Treasury market. So we're only focusing on yields right now. Projection into early 22 up to 1.8 to 2.2%. With a possibility up near closer to 2023 of about 2.6%. This would be a faster rise than really the Fed is pointing to, but the market is likely to get ahead, and the Fed has made mistakes all along here, as we know, calling for inflation to be transitory and then trashing the word transitory, and believing that there was going to be no interest rate hikes until 23, and now there's likely going to be at least 2 or 3 in 22 and 4 in 24. So the market is very likely to get ahead of them, and we would expect an upward spike in interest rates looking at this. So that's a look at the interest rates on a monthly chart. Let's take a look here as we switch over to the weekly chart for interest rates, and we'll get a little tighter look. So this is the weekly chart, and again, we have cycle analysis in here, and the dominant cycle, as you can see, we call this a base, where it was in a big decline and then it made a higher low. And then it began to make higher peaks and higher troughs. These arrows show you that these were positively configured cycles, and we have another one coming here. This points to about 2 or 3 weeks or so of some gyrating in here. In the beginning of the show, we talked about a range of about 1.34 to 1.55% for the near term. Maybe it comes down and tests that level again a little bit right in here, but these two vertical lines are the variance of time that shows you the bottom is likely coming. Then after that, these upward phases right in here align with the ones I showed you in the monthly. And that is likely to push up very sharply in here. Again, this gets you over 1.8%. This gets you to about 2.2%, depending on which track it follows. So this cycle right in here, the dotted lines are incomplete. And this really looks like this nesting period in here isn't putting a huge amount of downward pressure. Right there. You can see each of these nesting periods as you got the corrections in here. Not a ton of downward pressure. You still have a little time frame in here where yields could come down. But then after that, after a couple of weeks and coming into right around the beginning of January, we see a potential for an interest rate spike. We see, looking at the Treasury futures, that the period of weakness and of risk is really into March. So there's a period where interest rates should spike or the futures should fall very sharply out into the March timeframe. So that is a look at the TNX. I showed you the monthly, I showed you the weekly, and all of this points to an interest rate spike coming. We'll look for 1.8% and potentially 2.2% in the early part of the year, and that is likely to shake things up if that does happen. So that is a look at the interest rate market. All right, let's look at the stock market. We're going to look at the SPY weekly and daily analysis. Before I get into that, I want to remind you there's only 9 more days in our holiday special, and we have added in this amazing market monitor. If you didn't see that at the beginning of the show, go back and watch it. RV presents it. You have to get it. For our level 4 and level 4 plus members, there's only 4 more days. This is an amazing monitor that you see here. There are only 50 packages that we're going to give this to. along with this level 4 and level 4 plus, this special added bonus, along with us sending you an Amazon gift card. So great stuff here. Do become a level 4 or level 4 plus member to get this scanner. All right, stock market. Let's take a look at this. We're going to look at the S&P 500 weekly and daily, and we'll take a very interesting picture in here when I switch over to the SPY. So we are in a period in here where the market is rising in favorable seasonality. The issue is that the broad market, there's been a ton of deterioration in here. So an important low came right over here. And what we have in here are cycle harmonics that are slightly out of phase, 9 week and 26 weeks. So this low right over here was a 9-week cycle right over there. This is where the 9-week and 26-week cycle made the bottom right over there. And that was clearly this dominant low right there. So it got this correction right in here of 5.2%, and now it's been really churning, getting back up close to the all-time high. And we talked about the potential of the S&P 500 nudging out that all-time high, while the other indexes, the Nasdaq and the Russell, would not, and they are looking much worse. So we have the higher cap stocks that are rebounding in here, and it's pushing this up. Momentum has turned flat, as you see in here, waffling around just a little bit, while the momentum in the Nasdaq and the Russell are clearly negative. It came down here, it hit support, but it gave up a lot of ground. And I'm going to show you in just a moment the short-term patterns that look like we're coming back into a period of risk soon. This is that period that starts January, February, and into March, that there is a lot of risk right in here for the intermediate term. So our 3-month view really is that it nudges out a high in here with the other indexes not doing so, and then it gets into a period of continued volatility and a much bigger break where you have at least a 10% correction out into March, with a potential of much more of that out into March. Best case I can make is 425 here out into the March timeframe. I do believe it could get down closer to 400 in the SPY in that timeframe. So this is the beginning of a period of risk out over here, and this is just, in my opinion, a test of the highs where it might just take it out by a little bit. That's the SPY on the weekly. The SPY on the daily, I have a little more information on here that I think is important. So you can see this big dash cycle is the Russell. And the Russell had a breakdown right over here on 11/18, and it is in much worse shape than what you see in here. And here are your cycle rhythms in here. These are about 20 days on average, and this is the big dominant one for the Russell, about 40 days on average. We're getting into a period right over here after the next couple days where the risks should pick up again, and we're looking for weakness that will occur after Christmas and into New Year's, and then into the early part of the year. This next trough in here is between January 4th and 12th. Now, the NASDAQ had a breakdown on Monday of this week. It actually got below this level, and the S&P 500 getting down close to it tells a bad story. So it really says that this should fail again right up in these levels or just above it, and then begin to come down. So we see risk in the market coming in just the next couple days for another one of these kind of sell-offs that we've had in here. And you can see the range that we're in, though it might just nudge out the top of that range at the all-time high, 473. We think it will coming back down here closer to that 450, and then do this again out over here into January, where, remember, we thought it would come sometime out over here where the high was made. Again, this could take out the highs on the S&P 500. We do not expect that to happen. And then after that, the bigger decline out into February and March is really where that begins. So we see a lot of choppy time frame in here, and we talked about a complex top forming, and that's really what that looks like to us. So we'll be looking for A failure coming in this area, another sell-off, another rally attempt out into late January, and then the beginning of the February and into early March, bigger decline and bigger correction. This area where that low is made in here, the low there is about 450 right there. Once that's taken out, it declares a major top to us. So it's avoided it while the NASDAQ had a breakdown on 1220. The Russell had its breakdown on 1118. And all of that points to a divergent market right now, which we see, and the likelihood that nudging out these new highs is not going to mean much, and the market is very likely to get waves of selling on the downside. If you follow our VIX analysis, which I'm not going to show you right now, we've talked about the fact that there's another pop likely coming in applied volatility starting in about a week. Or less. So we think there's lots of pops coming in applied volatility based on this pattern. It would not surprise me if the range didn't break to the downside until later in January, but that's what we expect. We think there's probably 1% upside potential from here and 10 to 15% downside potential. That's a pretty big call when I look at that, but the risk rewards, based on all of our analysis in here, and I'm showing you that side-by-side analysis on the weekly and the daily, say that there are waves of selling likely coming in the market, with the first one potentially coming starting next week between Christmas and New Year's. So that is a look at the stock market. I hope you found that to be extremely informative. Again, I'm going to invite you to become a level 4 or level 4 plus member using our Christmas special. We're going to send you back a bonus of an Amazon gift card, and we're also going to give you the bonus of our amazing new scanner with our proprietary indicators on there. Please do go to the website and look around on YouTube, subscribe to this channel, click that bell. You'll get notified when we put up videos. Like this video, give it a thumbs up, and watch our member videos in the playlists here and past shows, and you'll get a good sense for what we do if you're new to the askSlim site. And on Twitter, follow us at askSlim, and make sure that you do write to Matt if you have any questions. A couple of announcements. There's no market week next week. We're on semi-vacation, and we'll have no videos at all next week. I want to wish you a very happy holiday. Health to you and yours. Tons of joy coming during this holiday and for the new year. We just absolutely love our members, fantastic people, and all of the people that follow us. So all we want you to do is to be well and to be successful, because your success is our success. That's it for this show. I want you to be so careful out there because it is so crazy. And I'm always wishing you great trading.